Today we come to the last point of LKAS 12 income taxes. I hope I can finish it within short period of time. Here's few slides. Right? And today's session is about taxation in company's account. Before this session, we have discussed in deep manner about income taxes, the from the double entries, and we have understood the logic behind the deferred tax. So what is taxable temporary differences? What is deductible temporary differences? Right? Deferred tax assets, deferred tax liabilities, current tax expenses. We have discussed a lot, and the reasoning or logic behind of each transaction, each records regarding regarding income taxes. Now we move to little practicable company's account. There's no calculation here, but just to remember what you have studied earlier. Here, taxation in company accounts. This is our topic of our session. In the statement of financial position, that is balance sheet, the liability for tax payable is the tax on the current year profit. Normally, we pay the taxes end of the financial year, no? End of the financial year. So, for example, if the accounting year starts from 1st of April 2019, it will end up on 31st March 2020. At the date of 31st March 2020, no companies pay tax. Again, they take 6 months of time to calculate taxable profit and to make some adjustments. After that, they will pay tax. So we have to prepare the statements, the balance sheet or income statement at the balance sheet ending date, at the end of the financial period. So that time normally we not pay that tax. Therefore, all the times we have a liability called tax payable, estimated tax payable. So that is current tax. In the statement of financial position, the liability for the tax payable, is the tax on the current year profit. Current year profit. The statement of profit loss account, the profit income statement, the tax on the current year profit is adjusted. Right, in the beginning of LKAS 12 income taxes, we have done some small basic questions regarding uh, under provision and over provision, like that. Now we connect that concept to here. So in the income statement, the tax on current year profit is adjusted for transfer to or from deferred tax balances. Right, the current tax will be adjusted with deferred tax balances. It may be in the form of deferred tax asset, deferred tax liability, and the previous year's under provision or over provision. So the current taxes should deal with three things: the current tax for the period, and over provision and under provision from the previous period, and deferred tax balances. So all these three things should be incorporated in company accounts. We have now look at the ingredients, the components of taxation in company accounts. There are two aspects to consider. taxation on profit in the statement of profit loss account, that is income statement. Taxation on income statement. Taxation payment due is a liability. Tax payable shown as a liability in the statement of financial position. So we can find there are two elements. One is a taxation on income statement and tax payable on balance sheet. That sort of things. Right. Taxation in the statement of profit or loss income statement, PL account. In the tax on profit on ordinary activities. So we have yesterday discussed extraordinary activities such as value revaluation of assets and liabilities. So that are not ordinary activities, extraordinary activities. So sometimes what other comprehensive income. Right? The tax on profit on ordinary activities is calculated by aggregating income tax on the taxable profit. This is for the current year. Income tax on taxable profit. Current tax, simply we say current tax. Transfer to or from deferred tax. So there are changes, there are differences between tax base and the carrying amount. So there will be a chance to incur temporary differences. Due to that temporary differences, deferred tax will be arise. It may in the form of deferred tax assets or deferred tax liabilities. In addition to that, any under provisions or over provisions of income tax on profit of the previous year of previous year. So the subsequent paragraphs is explains about provisions, under provisions and over provisions. When income tax on profit is calculated, right? When income tax on profit is calculated for the year, the calculation is only an estimate of what the company thinks its tax liability will be, right? Uh, Normally, accountants will be estimate, the predict the amount of tax payable to the government according to the tax rules, not the accounting rule, the tax rules, right? Accountants will be estimate the taxable profit. Based on the taxable profit, they will calculate tax amount. What happened after submit the taxable profit to the Department of Inland Revenue, it means tax authorities in Sri Lanka, sometimes they may not agree with our balances. Right? Sometimes they wanted to pay tax more, and they will inspect, they will analyze each and every element in our financial statement. So for example, uh, our accountant has quoted an expense that, for example, a dinner to employees, dinner to employees. But the tax authorities argues that this dinner expenses is not contribute to earning profit for the organization. Therefore, these expenses cannot be considered as a business expenses. Therefore, you have to uh, increase your profit on this amount. So there will be some argument between the company representative and the tax authorities. So due to this kind of disagreement, we have to pay more tax, sometimes less tax, very rarely. So the calculation is only an estimate of what the company thinks its tax liability will be. Say for example, based on our calculation by following tax rules, I have estimated 10,000 will be a taxable tax. Well, 10,000 will be tax. But when I submit the financial statement to the authorities, they says no, not 10,000. You have to pay 15,000. Right? This kind of things will be happen. It is normally happening. In subsequent dealings with tax authorities, a different income tax charge might eventually be agreed. Right? Then finally, we agreed with we argue 10,000, they argue 15,000. So due to several discussions with the officers, now they have agreed say 13,000. Right? So due to this cause, under provision and over provisions will incur. The difference between the estimated tax by the accountant, company accountant on profit for 1 year, and the actual tax charge finally agreed with the year is made an adjustment to taxation on profit in the following year. Right? Say our our period, financial period ended on 31st March 2020, but this kind of scenarios, submission and arguing with the tax authorities about the tax payment will be happen after the balance sheet date. After the balance sheet date. And under provision and over provision will be impact on the next year. Following, right? Resulting in disclosure of either under provision or over provision of tax. Now, taxation in the statement of financial position. Earlier it was on statement of profit or loss. Now we look at on statement of financial position. It should already be apparent from the previous examples that the income tax charge in the statement of profit loss will not be the same as income tax liabilities in the statement of financial positions. In the statement of financial position, there are several items which we might expect to find. If you take an balance sheet statement of financial position, we can find these things regarding tax, income tax. Amount underprovided or overprovided. Sometimes we call it under provision and over provision. In previous years, under provision, over provision of income tax. These will appear as debit or credit to the tax payable account. If no tax payable, there's no tax for this year, then there might be an income tax recoverable assets disclosed in the current assets, right? So no tax because of we have already paid more tax in previous period. Due to that, we made deferred tax assets. So it can be recoverable, set off that, no? So then there might be an income tax recoverable assets disclosed in current assets. It means income tax is normally recovered by offset against the tax liability for the year. There will usually be a liability for tax. There will be usually be liability for tax assessed due, that's mean income tax payable for the current year. Right? As I told you earlier, at the balance sheet date, it's payable. No, it's estimate no, the payable. Most of the time, it's payable. We might also find liability on deferred tax account, deferred taxation account. Deferred taxation is shown under non-current liabilities. Deferred taxation is shown under non-current liabilities in the statement of financial position. And finally, the presentation of tax assets and liabilities. Presentation of tax assets and tax liabilities. These should be presented separately. The items regarding tax in the statement of financial position should be disclosed separately. these should be presented separately from other assets and liabilities in the statement of financial position. You have to, as an accountant, you have to clearly mention these items are related to tax, income tax. Deferred tax assets and liabilities should be distinguished from current tax assets and liabilities. Right? The current tax asset and current tax liabilities should be separately presented in the financial statement regarding the deferred tax. Deferred tax or liabilities should be separately identified. In addition, deferred tax assets or liabilities should not be classified as current assets or current liabilities. Right? Deferred tax assets or liabilities should not be classified as current assets or current liabilities, where an entity makes such distinction. So if there are any special arrangement only, we can present under the current liabilities. Offset, cancel off, no? Cancel each other. That's mean offset. There are only limited circumstances, very rare circumstances, where current tax assets, current tax assets and current tax liabilities may be offset. Each other will be cancelled off in very rare situations. This should only occur in two things apply. So if they decided to offset current tax assets and current tax liabilities, you have to satisfy two things. Number one, the entity has a legally enforceable right to set off the recognized amount. Legally enforceable rights. And number two, the entity intends either to settle on a net basis. The entity intends to either to settle on a net basis or to realize the asset and settle the liability simultaneously. Right? So they can uh, realize the assets or settle the liability simultaneously, then they can settle. Similar criteria apply to the offset of deferred tax assets and liabilities. Here we talk about the current tax. We can talk about current tax. Here the same principle will be applied when we set off the deferred tax assets and liabilities also. Presentation of tax expenses. Final last At last we discussed about this presentation of tax expense. The tax expense or tax income related to the profit or loss for the year should be presented in the statement of profit loss account. So for the tax amount for the year should be presented in the statement of financial performance, income statement, very clearly. Tax expense or income related to the profit loss for the year should be presented in the statement of profit loss account. Right. This is end of LKAS 12. If anybody having any troubles